Welcome to the Accumulating Wealth Podcast. I'm Hunter Satterfield.
And I'm Judson Crawford. We're CPAs, wealth advisors, and partners at Kane Waters and Associates, a financial services firm here to help business owners navigate the decisions they face every day.
That's right. And this week, we're going to continue our back to the basics, connecting some of the timeless things that we talk about all the time, Judson, with maybe a little bit of our current economy and economic makeup. This week, the 5 savings environments.
All right. Sounds like we got lots to cover. Let's dive in.
Okay, Judson, before we get to the 5 savings environments, which are fun, and we talk about them even with long-term clients. But we have the whole like government shutdown thing going on right now.
Oh, yeah. That started today.
Hopefully by the time this drops, we're through that. If not, listeners, we'll come back to you with some like relevant stuff there, but we're not too concerned about that in the moment, right? But we had this great survey that just came out from Schwab.
Chucky,
I think came or sort of went along with our safe withdrawal rate episode, right? So let's do that. It's fun.
Yep. Okay, so what this survey said, Hunter, is that they surveyed 1,100 401k plan participants because you know what? They're not going to stop at 1,000.
No,
They're going to go 10% above and beyond.
1,101.
1,100 plan participants reported that they expect to need an average of $1.6 million for retirement.
Seems low.
Well,
I guess it's an
actually
average.
down. It's actually down from what that 1,100 respondents reported in 2024.
Well, that makes sense because we're in a deflation environment, right?
Wait a minute. I don't think that's what we said on the last podcast.
No.
So inflation's up and interest rates are down and we need less for retirement.
This proves that surveys are terrible.
It's true.
But it is good. It's kind of a helpful number. And I guess the number's close. So I guess people tend to think that's about the number.
Well, I mean, and I guess really what doesn't go along with this is that we have no idea what assumptions these people are making. So we have no idea like what these 1,100 people think they need to live off of in retirement, right? Because we talked about it before that, you know, when we talked about the safe withdrawal rate with Mr. Brian Bortz, that, you know, we probably feel somewhere comfortable between, let's say, the 5 and 7% range for your safe withdrawal rate. You know, so for $1.6 million, I'm not that good at math, but we're talking about, you know, somewhere between what, $80,000 and $95,000 a year on living expenses. I mean, hey, you know, if you add in Social Security, you could probably have a decent retirement off that.
No, I mean, it's not. And actually, I thought that the sort of interesting thing to go along with this was they asked people which obstacles they thought were the biggest obstacles for as far as having a comfortable retirement. And these are interesting. We should go through these very quickly because number one, which is the exact same as it was a few years ago, is inflation. So 57% of people indicated that was a concern of theirs.
Well, especially they're concerned about it because they think they need less in retirement.
Exactly.
So like, but this inflation thing doesn't match up very well with what I just said.
Yeah. Number two was 38% of folks said keeping up with monthly expenses. I guess that's like
Same.
I guess that's kind of like what can I spend?
Yeah.
Yeah. Maybe that's what that means. Third was stock market volatility, which, you know, we've
Fair
talked at
enough.
length. Yeah, totally fair. And then the last,
and it's not going to go away.
Exactly.
Like in general.
yeah, a third of people said that was a concern of theirs. And then the last one, which also came in right around a third, was unexpected expenses, which we've talked about that one before because one of the things that, you know, for you and I with our retirees that a lot of times we get is, I don't want to see my assets go down. What happens if a big expense comes up? So that one makes a ton of sense for me.
Yeah. And I think, I mean, again, most of this really, when we talk about concerns outside of market volatility, everything really boils down to spending, right? All of the concerns boil down to spending, which is really very appropriate when you're talking about a conversation about retirement, right? I mean, it's something that we talk to our clients about quite a bit. And you know, when we think about when we talk about that, when it's again keeping up with monthly expenses or adding in unexpected, I think the way we do that is, you know, probably more conservative with what we estimate for our clients, right? We're not trying to, you know, dial it down for most of our clients. We're not trying to dial it down to, you know, some sort of minimum of what they're going to spend. We try, if we have time, especially if we have time in your retirement plan, we're trying to be conservative so that we're building in, you know, some natural unexpected expenses And then, when we really dig into the lifestyle, we're building in, like for instance, I typically will put in a good, healthy budget for repairs and maintenance on the home, right? Because it may not be something that comes up every year, but if you have ever owned a home, you know that stuff comes up, right?
Yeah, I tend to go the direction. I do the exact same thing. I tend to go the direction and just say, hey, per house that you have during retirement. So if you have, maybe two or like a condo and a house or whatever else it is in two locations, I usually say 50K of non-discretionary spending. So like real estate taxes, property insurance, repairs and maintenance, utility bills, things like that. And that kind of helps set the scene a little bit. I mean, obviously, if these people are thinking they need 80 to 90K a year plus Social Security, they're probably living in smaller homes or renting apartments or whatever else it is. But I think that's typically what I do for clients as far as a number goes. Now, I think as we complete sort of roll up this topic very quickly or wrap this topic up, I think one of the things to me that comes down to this is all those things, like you said, they come down to spending. And I think that's why that safe withdrawal rate is so important, which is why we wanted to cover the survey data. Ultimately, if you've got your safe withdrawal rate of 5, 7%, whatever else it is, that's encompassing all of these things. It's encompassing inflation being in there. It's encompassing major repairs and unexpected things you might not have thought of. And what you have to do during retirement is you just have to pivot. If a big unexpected expense comes up, it just means that we've got to potentially cut short term in another area. So focusing on that safe withdrawal rate, I think ultimately is the way to not have these concerns.
Yeah, and I think again for a takeaway for our listeners, I think that if you've not spent any time, if you think about your retirement plan, but you've not really spent any time thinking about what your spending looks like in retirement, a couple little things that I would say. Number one, if you're in the mode, many of our listeners are, where you are, you may have children, and you're clearly spending a lot of money on them because they're expensive. You are in a time where you have a mortgage. You're in a time where you may have automobile payments, and let's say that you're spending $15,000 a month. Okay. My recommendation would be don't necessarily assume that your spending in retirement is going to go down, right? It's just that a lot of those expenses that you aren't going to have at that time, like kids, like maybe a mortgage, you're going to hopefully be spending on more discretionary items, right? It may not be that you need to take that $15,000 a month to $50,000 a month, but definitely don't reduce it.
I mean, I would take it from 15 to 50. That sounds great.
Okay.
I might run out in 2 years.
Depends how much time you have and how much ability you have to save. But if that's what your goals are, fantastic. Let's make it happen.
I might have to work till I'm 80.
Well, you're gonna work till you're 80 anyways.
Good point. Overall, this group was very optimistic.
Can you imagine what our podcast is going to be like when we're 80? It's going to be angry,
guys yelling at cloud.
Yeah.
That's exactly what it's going to be. Okay, but y'all, they were super optimistic. 15% of respondents said they are not likely to achieve their retirement savings goals. 85% are very optimistic there. I love it.
Those 50% sure are Debbie Downers.
Indeed. I have no shot of ever making these goals.
So I might as well not save.
Yeah.
Actually, that's probably a lot of Americans. I can't make it happen, so I just won't worry about it.
Yeah. Okay, so let's move into our back to the basics. And I think the best place to start, we both saw this like buzzy headline, freaking media. I can't stand them. So I'm going to read the headline from the Wall Street Journal. This is not some like hack, that's out there. This is the Wall Street Journal. And then we can sort of deconstruct it very quickly and say, okay, this is a little bit insane. But then I think that leads us into our 5 savings environments. So the headline reads, Judson, high earners, age 50 and older, are about to lose a major 401k tax break.
Bum, bum, bum. You're losing, guys, if you're 50 or older
and a high earner,
screwed.
You're screwed.
Yep.
You're losing
a major tax break.
Which, we're so far out in front. We're so good at what we do, Judson. We're so far out in front of this. We had already talked about this. And what it basically is, listeners, as a reminder, is depending upon your income, which for many of you that are clients of ours and have been doing what you need to do, you're going to be over the income. Once you're age 50, your catch-up contribution now, under the new laws that were passed well over a year now, your catch-up contribution, which is the additional 401k amount that you can save, is now going to be required to be Roth. So when they say that you're about to lose a major 401k tax break, it's just that instead of saving that money and it being pre-tax, now you have to save that money and it's now Roth. So that's the tax break that you're losing. But you're not losing an actual savings vehicle. That's the most important thing.
No, and mind you that what's the catch up this year?
75?
7,500?
Yeah.
So mind you that this major tax break that they're talking about is a deduction of $7,500. So, if you're in a state that has, let's say a 3% tax, so you're a 40% total tax rate, we're talking about, a total tax hit of $3,000.
Yeah.
Right. So, I mean,
But then nobody would read the article
it's true.
if they
We're
knew it
just,
was only
we're just going to
$3,000.
rip the Wall Street Journal into pieces and call it upset.
Well, and again, I think we want to go back to the basics like we did last week. It came to debt and say, okay, we've got Fed cuts coming, we've got new tax law that's coming. Let's go back to how does this actually impact a lot of the foundational sort of timeless things that we've taught here at Kane Waters for years. And that was where we were like, let's do 5 savings environments, right?
Yeah.
And so
we talked about debt last week,
yeah,
right?
yeah.
5 savings environments this week.
So you want to do let's start with what are the 5, and then we'll go from there.
Okay. Well, since you already touched on it, Roth. Roth is an easy one. Roth is money that you put in after tax. So just like this article talks about, you do not get a tax deduction when you put it in. It grows tax free. And then whenever you take that money out, as long as you are over the age of 59 and a half, anything you take out is tax free. So you basically get no taxation on any of that growth at any point in time.
With no RMDs. I mean, it is the best place. We've talked at length about it. The best place to be. We love you, Mr. Roth, for getting this passed back in the early or late 90s.
That's right.
The second one is pre-tax, which we've already also kind of covered here. So this would be a lot of your qualified retirement plans, so your IRAs, maybe depending upon your income, as well as mainly your 401k, DB contributions. So we are receiving a tax deduction on them now. We are growing those assets tax deferred. When we pull the assets out, that's when we're taxed on them.
Yeah, and both of these environments are limited because they are so advantageous, right? We can't express how much of a benefit it is that over a long period of time you do not pay taxes on the earnings that your investments are making. Next week I think we're going to try to touch on another timeless topic, which is compounding, and this really speaks to compounding. If you get to keep 2 to 3% that you would be spending in taxes every year in your portfolio, and that grows on top of each other, it's enormous. But the Roth section is limited much more than the tax deferred section. The Roth, you can really only get money into Roth by Roth IRA, which for most of our clients is a Roth conversion, Roth 401k deferrals, and now the catch-up being required to be Roth.
That's right. And then I guess also you get HSA, which is kind of a hybrid between the two. But to your point, there's just a limited amount each year. So they become super important. Both of these buckets, you've got to maximize them each and every year, each the most you can on an ongoing basis each year. Now, each of these buckets, I think one of the things that we now have with sort of permanent tax law, right? We've got permanent tax brackets. They will shift a little bit each year for inflation, but knowing, all right, now we have a 37% top tax bracket that is in place. I think that actually really helps define these buckets well from a strategic standpoint. Previously, it was always like, well, are we going to go back to 39.6? Are we going to go down to 35 or whatever else it is? Now knowing like this is the tax bracket, it's permanent until a new law gets through House Ways and Means. And so I think from that perspective, Judson, now the key thing is we just keep maximizing to the best of our ability. And if we elect to put something in Roth, whether it's our 401k deferral or something else that we get in, we just know it's going to cost us 37 now, but then we get that unlimited flexibility long term.
Yep. Third bucket, tax-free, which is limited, right? Tax-free, Roth is a tax-free environment. We have a tax-free environment, which really just comes down to, what investments are tax-free earnings. This comes back to, basically, tax-exempt bonds. What else we got in there? Whole life policies.
Yeah.
Permanent insurance type of policies. There's not much in there. It's not something that we use a great deal. They can be additive in some different portfolios, but not when we use a ton.
That's right. All right. Fourth is the sort of taxable environment, right? So this is going to be the one where it's like, I'm not getting benefits under, qualified retirement rules in the tax code. So I don't get tax deductions for them. I don't get preferred tax treatment along the way. So this is going to be opening like personal brokerage accounts, right? And then buying, stocks or mutual funds or ETFs or whatever else it is in there. You're getting taxed on your dividends along the way. You're getting taxed on capital gains that you might have. You have an opportunity to do tax loss harvesting, like we've talked about before. So that's it's a massive bucket. And that typically is the one that most of the income is going to go into after you've maximized the two qualified. And then if you are in a high income tax state, maybe that tax free bucket as well. And so again, in that one, it's not, people think a lot of times, oh, I get no benefit from a tax perspective in that bucket. At the end of the day, though, as we're about to talk about here, it does give you a ton of opportunity for savings. And then it also gives you this unique ability to provide tax diversification in your retirement plan, which we will talk about once we're through with the fifth bucket.
The fifth bucket is the corporate bucket. And for most of our clients who are business owners, this is really where the money flows through, right? And so, some of the things to think about in the corporate bucket is that, from this personal bucket, you want to take as many expenses as you can that you can legally move up to the business, right? Because we want to make them tax deductible. We've talked all about different things that you can spend in the business. Then after you do that, you want to thoughtfully allocate that money into the other four different buckets before you just take everything out to your personal environment. And that's really what we've taught our clients for years and years, because a lot of the ways you save into the tax deferred bucket and into the Roth bucket are decisions you make within the corporate budget before you pull it out. So, it speaks to, the plan. It speaks to, the retirement plans you have within the corporate budget, and that those need to be decided upon, before you make the decision to pull everything out. Because once everything's in the personal budget or in the personal bucket, that personal bucket has a big hole in the bottom of the bucket, and that hole is taxes.
That's right. And I think at the end of the day, when we sort of, again, reset to current, our current economy, right? Whether it's, again, tax cuts that are coming, or new tax law that we might have, everything's still tried and true here, right? Like nothing is changing necessarily from what bucket we should go into. You just gave the great advice, which is how things should flow. And what often we see when we have a new client that might come in is we'll see that you're in the situation where it's like, okay, you have some things in these 5 buckets, but your efficiency within them is broken. Like you don't even know about one of them or maybe 2 of them. You're not allocating your savings, appropriately between them. You're not taking full advantage of the corporate bucket. And so having, to your point, a plan where you're able to actually say, oh, I know I am maximizing the efficiency of each of these is the key. But that plan really, Judson, nothing has changed with all of the changes that we see in the economy right now, which is one reason why I got a little chapped at this headline from Wall Street Journal, because I'm like, you're trying to create this buzzy headline. At the end of the day, our advice is the same.
That's right.
It is unchanging that, yeah, you should still probably save your catch-up contribution. You're not losing anything. In fact, you're creating tax diversification in your portfolio, which will help drive better outcomes for your retirement plan.
Yeah, I think that there's, in the field that we work in, what I've seen, and I think this has gone by the wayside to a degree, mainly because, frankly, in our time at Kane Waters, the Roth environment got more restrictive, and then it started to open up a little bit, right? Because if we go back, I don't even know how many years ago it was, but 10 plus years ago, there was no Roth 401k savings. There was no automatic catch up. There wasn't even really, the ability to make large amounts of conversions, at one point in time. So we were really, really limited in Roth at some point. And, we found that advisors didn't even, some advisors from clients that came in had no advice given on even doing the annual conversion. So, Roth is a really important environment, but it was one that I think was underutilized by a lot of advisors for a very long time.
Yeah. And one of the reasons why you and I both, we were sitting in meetings when some of our clients would bring this to us, and it's like, oh, my friend or my advisor told me that, eventually they're going to come after your Roth money.
Yeah,
they're going
right.
to come after it. They might be giving you that benefit now, but eventually they're going to
change their mind.
Tax you.
Yeah.
Exactly. And at the end of the day, what we said was, we said, no, I think the reason the government drives Roth money and the reason they want that is because it gives them tax income right now.
That's correct.
And so they're not going to come back on you in the future. We said that 10, 15 years ago. Well, now we find ourselves in a world where they're actually expanding access into Roth. They want more money in Roth because they're trying to take care of their multi-trillion dollar debt problem. And so in this situation, those clients that took advantage of just piling that money into Roth over the years and now compounding tax free with no RMDs are going to win. And that remains our tried and true advice. You have got to get whatever money you can into the Roth bucket. And there's a whole lot of reasons why. Again, number one, the government's going to get less restrictive over time, not more. Number two, what we already talked about was that tax diversification. And again, when we come back to it, what that means is that when you enter into retirement and things change, because they will, it gives the Brian Bortz of your life or the Judson Crawford of your life the opportunity to be very creative because you have this money in these different buckets to say, oh, well, right now we're sitting with a higher tax regime. Let's go grab some of that Roth money. Or right now we're sitting in a lower one. Let's go grab some of the pre-tax or the taxable or whatever else it is. And if you don't have that tax diversification, your plan is at risk when unexpected costs come up, tax changes come up, or whatever else it is.
Yeah, and I know it doesn't feel like it to many of you clients out there that are paying it every year, but we are historically in a low tax environment.
Amen.
You know,
and now it's permanent.
And now it's permanent until it's not.
Until it's not.
That's right.
But that would require a new law, and
that's right.
Who knows what's going to happen there? So, well, you never know. We got government in a shutdown. We've got more Fed cuts coming. It's gonna be an exciting fall.
Well, you were talking about the government debt, and since they're in a shutdown and they have some time, they should really listen to our podcast last week about debt.
They should.
They could learn something.
Could you imagine if we got a hit from like Besant? He'd be like, I didn't know about
Scott.
That. I didn't know about that tax change to the Roth.
Scott, we'd love to hear from you. If you could reach out to us at kmwaters.com/wealth, we really do respond.
All right, get us out of here, man.
Well, the best way to keep up with this is to subscribe to this podcast. That way you never miss an episode, and you can always go back and listen to the other 250-something-ish. If you're enjoying the show, leave us a review. We really want to know what you're thinking, and it helps us. You changed this for me. So, guys, if you leave us a review, it makes us really happy, and it really lets us know what's resonating in your heart.
Have you ever used the word resonating until right now?
I was confused by this. It's memorized, listeners. And if you have a question, comment, or even an idea for a future episode, reach out to us at kmwaters.com/wealth. We really do read them, like I read this exit, and we actually do reply. And if you want to learn more about what we're doing, we're not behind the mic, visit kmwaters.com. We're helping more than 3,200. Good Lord, I'm having a hard time today, Hunter.
3,200 clients reach their long-term financial goals.
Thanks for listening to the Accumulate Wealth podcast. We'll see you next time.
Resonate.
It's a lot of letters.